Welcome back to another episode of Asset Coach and Tax Strategist. And I'm probably going to get a lot of hate on this episode. And this is part of the series that I've been doing with regards to understanding various assets, the stages of assets. This particular episode is about retirement accounts. Let's use a 401k as an example. That's the most popular retirement account that's out there. And it's really what the government's kind of pushing us to do. And the reason why I say I'm going to get a lot of hate on this is because I'm going to debunk really the benefit of a 401k. Now, from a tax benefit, right? So one of the things that we see, this is an asset at the end of the day. Plain and simple, it's an asset, right? And with assets, they're accumulating, they're growing based on the stages of an asset, right? So remember, when we put our money in, the contribution amount is the deductible amount, meaning we don't pay taxes on that contribution amount. And I'm going to share my screen and show you numbers and all this fun stuff. And so, but that contribution goes into the next stage or the accumulation stage. Okay. And then once we need the money, we have the distribution stage, don't we? And the distribution stage is where we take the income out. Now, retirement accounts are taxed as ordinary income. Okay, and to try to keep the numbers as simple as possible, because I can't project 20 years from now what taxes are going to be, right? If I were to ask you, do you think taxes are going to go up? Everybody says yes. Okay, and we are still at historic low tax brackets, even though it doesn't feel like it. I think they've really found the sweet spot since Clinton to now of our progressive tax system, the brackets, and really figured out the tax revenue continues to grow up. A lot of that has to do with the rules of inflation. And so, if you remember, one of the economic termites besides taxes is inflation. Okay, and so we're going to debunk this. We're going to talk about the retirement account as a tax benefit. Now they dangle that carrot. Now this is really the numbers. Will it work for you and fit for you? Are you a W-2 only employee and you have nothing else? This may be the best fit you have, right? But if you're a high income earner, like a business owner or a physician, this may not be the best fit for you. Okay. So I'm not saying that I'm not giving investment advice. This is just educational information and just trying to look at what we are told by all these financial advisors, by our CPAs, by everybody that this is, you got to do this, you got to max it out. Okay. And that's not advice for everybody. Well, it's free money if you get this or you get that. But is it free money? Okay. Now, granted, well, what if your company pays a dollar for every dollar you put in up to 4%, right? What if they give you that benefit and it's like, okay, well then put in 4% and get that dollar for dollar 4%. But how many companies do that? They don't. The majority of the companies don't do that. And so that's the key. Well, the profit sharing, a company giving it's profit sharing. Okay. So let's take this all the way back, get rid of all those what ifs, and let's just look at this from a box perspective and look at the numbers. Now, nothing is looking at things in a box. So that's not reality either. I acknowledge that. But what I want to do is understand the rules to this particular asset since we've been talking about that. Okay. And if you like this content and you like what we're doing, give us a thumbs up, subscribe if you haven't subscribed. If you have negative comments, you have positive comments, go ahead and put those below. That's perfectly fine. Give me a thumbs down. I don't care. This information is still very important to understand the numbers. If the numbers still work for you, then do it. I'm not telling you not to do it. I'm just providing another side of the coin to understand how this particular asset works. So I'm going to go ahead and share my screen here. And I'm going to use a spreadsheet. I'm going to walk through this spreadsheet with us for our dialogue and our conversation. And so let's look at this initially. Okay, let me kind of break this down. This is just notes. So let's say our wages, W-2 wages, are $100,000. Now, trying to use round numbers. At the end of the day, it really doesn't matter what this number is, other than what we need as income based on inflation at retirement. Okay. So I'm doing 2% inflation. This is the Federal Reserve's goal of 2%. Most recently, at this time of the recording, inflation has been higher, and we all believe that it's higher than what's been reported. Okay. But there are certain years where it's lower than 2%. So 2%, though, is the Fed goal. Now, remember, when you take this and divide it into the rule of 72, that means in 36 years, your dollar is going to be worth 50 cents. Okay. And 36 years from that, that 50 cents is going to be worth 25 cents. So that's 72 years from birth to age 72. Okay. The value has dropped twice. Okay. By 200, more than 200%, right? So 72, we're in retirement and we have about another 10, 12 years of life expectancy. Okay. So maybe longer, right? That's average. But let's look at these numbers. Okay. So I have our 100,000 of income. I'm going to assume we're maxing out the contribution at 23,000. We're below 50 years old. And I'm going to assume we're in a tax rate of 24%. Now, I will change this tax rate to show you what our tax savings looks like. So when you multiply 24% on 23,000, that gives you a tax deduction or tax savings of 5,520. This is what everybody's saying to do from a CPA perspective. And that's fine. That's fine. Short term, that's fine. You put in 23 and you got 5520 back. Okay? All right. Now, at the end of the day, we're going to need to look at a few things. So now let's say we did this over 20 years. So we put our $23,000 into our account, and let's say we earned an 8% rate of return. Okay. And this is an 8% every year. So this is going to be our average every year. Okay. Over a 20-year period, that money grows to about 1,052,525. Okay. That's a fair amount. Now, what's interesting is that you see this arrow over here in this 145. It's like, well, what's that 145? Well, that is your 100%, your 100,000 at 2% inflation. And that is over here, this category here. Okay. So let's go into this category here. But before we do that, let's take a look at this 5520. This 5520 over the same 20-year period, we saved 110,000. That's our tax savings. Okay. Now we can say, but Bob, this 23,000 that is growing tax deferred in this, we don't pay taxes on that. And you're absolutely correct. You are right. Now, when we look at the assets, the rules and stages of other assets are taxed at capital gains. Retirement accounts are taxed as ordinary income because this asset's purpose is to replace your income from your working years into your retirement years. So the government was smart and said these types of assets will be taxed as ordinary income so they don't lose tax revenue. Now, I get it. Financial advisors, CPAs say, well, when you get to retirement, you'll be in a lower income bracket. I have never met anybody who all of a sudden went to retirement and cut their spending by 30% or 20%, right? Your house will be paid off. Will it? Some people are very frugal and very disciplined, and they do pay off their houses. They're very frugal and disciplined and pay off cars and don't need cars, and they keep cars for 20 years. But that's not everybody. And when you're in retirement, do you buy a car before retirement? Or if you're retired for 20 years, are you going to keep your car for 20 years? Well, let's say I only drive for 15 of it in the last 5 years. I don't. Okay. Well, are you going to keep your car for 15 years or even 10 years? Okay. That's what we're talking about. And we're assuming a 2% inflation. So the cost of living is only going to be 2%. Okay, so here's all these already just different aspects of points of data in this conversation that kind of debunks that, well, you'll be in a lower tax bracket. As we age, do we get healthier? No, we are going to have to take medications or we're going to get need to take doctor visits. We're going to be in a situation where we're maybe breaking down, our bodies are breaking down. That's assuming if we're not traveling and doing all these other things that because now we're in retirement, right? So this adage or this concept of, well, you'll be in a lower tax bracket when you're retired, I think is BS. If you're frugal, you will always be frugal. If you have a nice lifestyle, you enjoy your spending your money and you're comfortable and you saved up money, you're going to continue to do that into retirement. Okay. Now, let's dive into here and start scrolling down. So $110,000 is our tax savings. And so now what we're going to do is we're going to take our 100,000 of income, right? So we're taking this 100,000 of income and we're going to start looking at this growth at 2%. Okay. Now this 2% is growing and our income need, the cost of living continues to go up. Now I'm only using 100,000. Okay. And what most people do that when you're putting in 23,000, that means you're what? You're really living off of what, 77,000. Can you do that? I don't know. So again, so these numbers may not even be accurate to that. Point is, we're going to leave these numbers the way they are. Okay. So once we get to 20 years, all of a sudden our income need is 145,000 based on 2% of inflation year over year. Okay. This is why inflation is called the silent tax. Okay. Because it will affect our taxation. It's a silent tax that the cost of living is going to require our income to be higher. So when we take our balance that was our balance from above, it now becomes our retirement beginning balance on that $23,000. Okay. Now we're not taking into consideration Social Security or anything like that, right? Just from again this box. Not everything is just in a box, but we're talking about this particular asset. Now, when we're looking at year 20, we have this, and so here's the tax, 24%. I didn't increase the tax rate, even though we may be in a higher tax. I don't know what the tax brackets are going to be, right? So I'm just going to use 24% to keep the numbers as simple as possible. So our net is 110, very close to what it was 20 years ago. Okay. I don't know if that's good or not. So the cost of living basically increased the tax and my net is about the same, right? Because I'm not putting more money into my retirement after 20 years, am I? And so here we go. We have our ending balance. So we take our gross, we subtract it out of our beginning balance. We multiply this by 8%. I'm still using 8% return. So this 906 is still growing at, we take the 145, the net benefit, and at 8%. Now, all of a sudden, we're at 906. And that's what our number is here. Okay. So that's what the 8%. Okay. Now, when we just continue this process and look what happens. Look what happens. We live off of this and when we are into our retirement years, in year what, 8 of our retirement years, we're running out of money. Ooh, Bob, that's not realistic. Well, I don't know. Is 8% realistic? 2% inflation realistic? Again, 8% is that high? Is 2% low? Again, a box. We got to use some numbers. So let's go into here and let's say, okay, at the end of the day, too, let's look at this. Let me back out. Let me back out a little bit and let's look at these numbers here. And I'm going to look at what we want to look at is the taxes that we paid in retirement. Okay. So we'll just go to right here. We won't include this 41,000 in the last year. That's 300,000. We paid 300,000 in taxes. Well, Bob, that's because, we didn't pay any taxes on the growth and well, yeah, I know. But we saved 110 so we can spend 300. You see what I'm saying? Would it have been better to pay this 110 to grow our money in other areas that are more tax efficient than creating a ordinary income tax bucket of money? Okay. Well, Bob, if we get bonuses or if we get matched from our employer, that's free money. Yeah, but you still have to pay taxes on that too. So that just means that you may not run out of money right here, maybe down here because you got that free money, right? So let's delete that. Let's go change. I want to change our rate of return. Let's go to 10%. What's that look like? Okay. So we've increased our rate of return. All right. And let's take a look at that. Okay. So we last a little bit longer, right? So we go from 28 to 34. So another 6 years we're able to live. Now let's look at our taxes then. So we take our tax all the way. Again, I'm not going to include this 46 this last year. That's 558. Okay. But we've been able to live off of this money over the period of time. Absolutely. You're absolutely correct. But my point is that is this really that big tax benefit to us? And we're not including required minimum distribution. So if you didn't need this money, right? Because when we do it at a higher rate of return, we have a higher balance. And so we're starting with a higher balance, which extends that money for a longer period of time. Okay. Now let's go to, let's grow it by one more percent, 11%. Okay, that gets us to 20 years, right? Just barely. Okay, so let's look at what that tax looks like. And again, I don't want to include the tax of the last year. Let's just now we're at 850,000 almost of taxes that we paid the IRS. Okay. Wouldn't it have been just easier to pay the 110 in the beginning and put money into cash value life insurance or Roth IRAs or other assets that are more tax efficient where you can control the exit or even just have capital gains tax on those particular assets when you sold them when you needed them? Right. And you're able to defer them. So I guess my point is that it's not always necessarily. Now look at what happens here. When we change it to 12%, now look what happens down the bottom. Ooh, now we have a ton of money, right? We have a ton of money and we still have really the almost the same tax because it's based on the same income number. It's our balance that increases. So we have 2.4 and that gets passed on to our heirs and they pay taxes on this as in their heirs. Or do we hit required minimum distributions at a point where we're not taking out enough? And the government requires us to take out more to increase our taxes. Those calculations aren't in here either, which are also an equation. What if inflation increases from just 2% to 3%? Okay, look at that. That changes everything. Our taxes went up 300,000. We are running out of money at year 37, and we're still earning 12% every year for 40 years. Is that realistic? No, it's not. But you see what I'm saying? And I'm not increasing the tax rate of 24%, which it may or may not go up. I don't know. I'm not including state taxes either to change our tax costs. What if inflation actually is closer to 4%, which is where I think it will be moving forward, will be closer to 4%, a little more realistic. Now we're back at to 31 years. So now we've only been retired for 10 years and we're running out of money. Now that's at 12%. If we go back to 8%, whoa, I've only got about 5 years of retirement. All of this was because we've been sold this bill of goods of this tax savings, right? Wow. Awesome. Right. So again, like I said, I'm going to get a lot of hate on this. I'm certain of it. That's okay. Everyone's got an opinion. But my point wasn't to say that this was a good asset or a bad asset. It's just saying we got to understand the numbers. And if this is the only thing you have, then do this, right? It's better than nothing. But at the end of the day, there are other assets. We have to do other things. Okay. Now I base this on 100,000 of income. So if our income need or expenses were higher and more need, these numbers change completely. So the maximum contribution of 23,000 is not going to suffice. It's not going to suffice. Again, looking at this in a box and not taking into consideration anything else. So you may have Social Security that you can add to that. Great. Do I need more of this money? Do I need less? If I use less of this, will I hit my required minimum distribution number to where I'm going to be forced to take out more money down the road? Again, these are all variables and data points that we don't know, right? These are a lot of what if variables. But when we look at it from a box perspective and create data points and having something to speak of and talk of, is this a good asset to only be your only asset? Are 401ks what they say they are? Are they this great tax benefit? I don't know. I don't know. Based on these basic numbers and these variables that we put and these data points we put, no. It is much more complicated than what I communicated here, right? That's also the point, is the complication of trying to guesstimate what you're going to need. But people say you're going to need $2 million at the end of the year or at retirement, over $2 million. Will that be sufficient enough? Again, I don't know. Will you work in retirement? I don't know. But we need to know the basics of the rules of assets because these are the things that people tell us that makes us so great without taking into consideration all these other data points and other variables into the equation. Okay. So anyways, hopefully this was helpful. If you like this content, give us a thumbs up. Again, if you haven't subscribed, subscribed. I appreciate you joining us and investing your time with Asset Coach and Tax Strategist, and look forward to seeing you in the next episode. Thanks so much. Bye bye.